How is everyone doing? Welcome back to another episode of the Banker Next Door. I'm your host, Dr. Joe Berquist. So this is Report Week, and Report Week just continues to roll right along. So we are going to be looking at a CSBS report year, actually a 10-year research report that they did on overall compliance costs. And they found out that smaller banks are paying a lot more for compliance than bigger banks. Not necessarily a shock per se, but definitely a research study that caught my eye. But before we jump into that, I just want to say if you didn't catch the first two episodes of the week, so on Monday, I did a report. The San Francisco Federal Reserve Bank did a whole report on tariffs, 150 years of tariff research that they did. So that really great report. Go check that out. And then yesterday, I did the bank director. I covered their 2026 bank M&A survey. So if you haven't had a chance to go check out those episodes, go check them out real quick. But with that being said, let's dive into today's report. So this is coming from what's called the Conference of State Bank Supervisors, the CSBS. Now, the CSBS, they don't put out a ton of research, but when they do, it is absolutely worth looking at. They do an annual report on community banks, which is one of my favorite reports I love to look at every year. But they also put out some other stuff like this one every once in a while. So again, when they put something out, always worth looking at. So this report is called Too Small to Scale: What 10 Years of Data Say About Community Bank Compliance Costs. So for years, community banks have warned that the growing thicket of federal regulations is suffocating smaller institutions. The compounding effect of these rules lands hardest on the banks least able to absorb them. The refrain has become familiar. Small community banks don't have armies of compliance officers or sprawling technology budgets, yet they face regulatory mandates often meant for larger institutions. Most of that argument rested on anecdotes and institution rather than solid quantitative evidence. But now, drawing on an unusually rich data set, a decades worth of information from CSBS annual survey of community banks, covering 2015 through 2024, we have statistically significant evidence behind the claim that regulation weighs more heavily on the smallest banks, and the empirical findings are hard to ignore. So how the CSBS Community Bank Survey measures compliance burden. So in each annual survey, hundreds of community bankers estimate how much of their operating costs go toward compliance, broken down into categories such as personnel, data processing, legal, accounting, and auditing, and consulting. Responses to the bank's financial statements were then matched to the surveyed banks and then grouped into asset size quartiles to see how the burden scales. The research question being asked is deceptively simple. Are smaller banks devoting a greater share of their resources to compliance than their larger peers? And if so, how large and how consistent is that gap? So smaller banks consistently spend a higher share on compliance. So the short answer to the first question is an emphatic yes. Across 10 years of data, 4 of the 5 expense categories show that smaller community banks shoulder a markedly higher proportion of compliance costs. The answer to the second question is that the differences are significantly large and consistent across all years for 4 of the 5 expense categories. So which cost categories show the biggest gaps? Now there's 4 charts here, and we're going to go through each one of these. So, but let's read the description for each one as we go through it. So as shown in chart 1, for personnel costs, the largest overall expense category at most institutions. Obviously, yes, your people are your highest expense. The smallest banks reported spending roughly 11% to 15.5% of their payroll on compliance tasks, compared with 6 to 10% at the largest institutions, a statistically significant gap every single year. The pattern repeats across other categories, but let's take a look at this. So chart 1, community bank personnel expense attributed to compliance. I mean, that's, again, what you have to keep in mind is that these are people that they generate no profit for the bank. Like, I remember a bank, if you're a banker, you understand this. If you're not a banker watching this, like again, people kind of sit there and are like, oh, the banks. You got to remember something. A bank is a business like anything else, and you are in business to make money. The better you do, the more profit you make, the more money you can wait for it. You can return to shareholders. You can donate to the community. You can pay your employees more money to keep the, pay the talent that keeps the business running good. You can do all those things as long as you are generating a profit. But when you have to put a huge chunk of your money into things that just cost you money and don't do nothing to generate money for you, that's a problem. Now, again, I'm not poo-pooing regulation. I'm not saying, I mean, we absolutely have to have bank regulation. That is absolute. There's no. I'm not one of these people saying like, oh yeah, just get rid of all the regulation or whatever. No. I do want less regulation. I do want smarter regulation, because I think what you see over time is that regulators don't get rid of regulation. They just stack. They just stack more regulation, more regulation, more regulation, and this is why we're sitting here and we're seeing banks paying 14%, basically of their cost to basically just dealing with regulation. So this is a problem. Like this is money. Like even if you let's reduce that. Let's cut that in half. Let's bring that back down to 7-8%. How much does that in and of itself dramatically change the financial picture for a lot of banks? Let's just think about that for a minute, okay? But let's look at number 2 here. So chart 2 shows that data processing costs consume 16.5 to 22% of small banks' budgets versus 10 to 14% for the largest quartile, meaning larger banks. Accounting and auditing expenses devoted to compliance ran 5 to 17% points higher. That's on chart 3. So let's take a look at chart 2 for a second here. So chart 2, community bank data processing expenses attributed to compliance. Again here, yeah, I mean, it's crazy. I mean, like 15 to 20%. Data processing expenses contributed just to compliance. I mean, it's crazy. Chart number 3, community bank legal expenses attributed to compliance. Look at this, up between 20 and 25%. I mean, this is crazy. And then let's go back up here for just a second. So chart 4, roughly 50 to 64% of the smallest banks compared with 19 to 30%. I'm sorry, I missed that. Sorry. So consulting costs diverged the most, as shown in chart 4, roughly 50 to 74% for the smallest banks compared with 19 to 30% for the biggest. Only in the legal category did the differences wobble, with smaller banks still spending more, around 17 to 31% versus 14 to 21%, but without consistent statistical significance. So let's take a look at chart number 4 here. Community bank consulting expense attributed to compliance. So again, yeah, I mean, look at that. I mean, almost 50%. I mean, that's the second quartile is right up there, but you can see a third quartile and the largest quartile much, much lower, almost literally half the cost. That's why. I mean, that's wild. That's wild. So let's go down here. So why compliance costs hit small banks harder? Well, the evidence puts forth a clear conclusion. Regulatory costs behave more like a fixed overhead cost than a variable one, meaning they do not scale down gracefully. The smaller the bank, the bigger the bite. Why does that matter? Because regulation, though essential to protect markets and consumers, carries real economic trade-offs. Every dollar that goes toward more personnel, staff time, paperwork, data systems, and external consultants is a dollar not spent on lending, innovation, or community bank outreach. Exactly. That is exactly the point I was trying to bring home. Is that it's, again, regulation. Nobody's debating that we need regulation. Got to have it. It's essential to protect markets and consumers. However, you have to realize that it carries real economic trade-offs. That's the whole point. Now, post-crisis regulatory environment and its impact on community banks. These findings fit within a longer-running story. Regulatory volume and complexity have increased over decades and accelerated sharply in the aftermath of the 2008 financial crisis. Post-crisis changes, whether from the Dodd-Frank Act, Basel III capital rules, or expanded consumer protections oversight had the cumulative effect of raising regulatory compliance costs. While large banks could absorb those fixed costs, community banks had to spread them across far fewer employees and smaller balance sheets. Many responded by merging or exiting certain lines of business altogether. The number of community banks in the United States has been falling steadily for decades, but the pace of decline accelerated after 2010, and new bank formation has nearly vanished. Regulation is not the only culprit, but these data suggest it is a significant contributor. So, what this study adds to existing research? Well, the detailed working paper reviews the literature on compliance costs and economies of scale in banking. Some earlier studies found hints of the same pattern. Fixed reporting and internal control costs erode small bank profitability, and others linked rising regulatory complexity to consolidation, arguing that big banks can spread those costs while small ones cannot. What distinguishes this study from earlier research is the use of direct longitudinal data rather than proxies or simulations. The result is an empirical foundation based on 10 years of survey data as opposed to what had been mostly qualitative arguments. Then it gets into, how small and large banks differ, policy implications, why proportional regulations matter, what policymakers and bankers should take away from this. So let's look at this for a second. And what ultimately emerges is a portrait of a banking system under strain. Compliance, once a background function, has become a central line item in community bank budgets. The smallest banks devote upward of a fifth of their data processing and personnel expenses to meeting regulatory expectation, costs that large banks can absorb easier. Over time, that imbalance contributes to consolidation, reduces the diversity of the banking sector, and limits access to credit in small towns and rural areas where community banks are often the only lenders. This research suggests that policymakers must rethink their approach to tailored regulation and supervision, rules that achieve safety and soundness and consumer protection without unintentionally tilting the playing field toward concentration. So the takeaway for policymakers is clear. Proportionality matters. Regulators can uphold prudential standards and consumer safeguards while recognizing that a small rural bank and a much larger urban bank operate in entirely different universes. Proportional regulation, safe harbors, and support for technology adoption would preserve both stability and diversity. The takeaway for bankers is equally clear. Measuring and communicating compliance costs is essential to shaping smart reform by quantifying the burden with hard data rather than anecdotes. This research gives community bankers and policymakers an empirical foundation for that conversation. Resilience in the financial system depends not only on well-capitalized large banks, but also on the health of the thousands of smaller institutions that finance local businesses, farms, and families. If regulation becomes so costly that it drives those banks from the industry, the result is less competition, fewer choices for consumers, and great systemic fragility. This research illuminates that paradox and points towards a constructive path forward, the one where rules are strong but smart, burdens are shared more fairly, and community banks can keep doing what they do best, serving their communities. Yes. So again, absolutely fantastic report here from CSBS, really showing the overall burden and cost of compliance, and it's showing the overall effect on the industry as a whole. The fact that de novos have become next to non-existent. The fact that we've seen massive consolidation over the last 15, 16 years in the banking business. The not only the consolidation of banks, but also the consolidation of everything into your top, the top 8 banks in this country have 80% of everything. They have 80% of all the deposits, all the lending. That's a massive concentration now in the top big banks in this country, specifically the big 4 of Citibank, Wells Fargo, Bank of America, and JP Morgan. They are the very definition of the big players. I mean, they're too big to fail. And we still have about 4,500, 4,600 banks in the country. And so we still have thousands of community banks all over the US, and we need to make sure that those banks do not disappear. And so we really need to take a look at the regulatory burden that is on these banks right now. And I guarantee you, one of the major reasons why banks sell every year, because of regulation, no doubt, absolutely no doubt. The ongoing cost of regulation, if you want to grow the bank it just costs you more and more money. And that's why the moving of the thresholds, this conversation around the thresholds is so critical right now, because if we can move those thresholds back, if you go from 1 billion to 5 billion, from 10 billion to 30 billion, from 50 billion maybe to 100, you push those thresholds back, and you're going to allow a lot of banks to be able to basically keep on growing, and they're not going to have to consider selling the bank just to deal with the regulation. So, okay. That being said, what was I going to say, Aaron? What are we? Report week. Thank you. Report week rolls on over the next 2 days. I got a couple more bank reports for you guys. So I hope you're, and like I said, I hope you are always enjoying the bank information that I bring everybody. But with that being said, I'm going to wrap up by saying, if you like this episode, please make sure to like, share, and subscribe, as that really helps the channel. Remember, we are on YouTube, Rumble, and all major podcast platforms. Please be sure to leave your comments down below, as I always love getting back to everybody. And as always, make sure to check out some of the other content on the channel. I thank you so much for listening. I hope everyone has a great day out there, and I will see you again real soon.